Ever feel like you're trading blind? You've got the perfect setup, but the trade just doesn't work out? That's usually because you're missing one crucial piece: market internals. Today, I'm going to break down what they are, why they're a must have tool, and how they can completely change the way you time your trades. What are market internals? Market internals are basically the heartbeat of the market. Instead of just looking at a single stock or index, internals show you what's happening under the surface across the entire market. Some of the most popular internals are the VIX, or the CBOE Volatility Index. It's a key market internal that measures the implied 30-day volatility of the S&P 500 based on options prices, and it serves as a fear gauge to assess investor sentiment and potential market turbulence. The NYSE tick tells you how many stocks are trading on an uptick versus a downtick. The put-call ratio measures the ratio of puts to calls. And the vol spread measures the up versus down volume in the S&P 500, and it helps traders compare buying versus selling pressure. These tools let you see if the market is truly supporting your trade idea or if you're about to swim against the tide. Why market internals matter. Here's the thing: as retail traders, we want to go with the flow of the market. We don't want to fight the tide. The market internals help traders get a feel for market sentiment and direction before it's obvious on individual charts. It's important to learn this market feel and to go with that direction when selecting trades. For example, if you're looking to go long, but the tick is showing heavy downticks and the advanced decline line is plunging, that's a huge red flag. On the flip side, when the internals line up with your setup, that's when trades have the highest odds of working out. How to use the market internals. Here's how I use them in real time. Number one, check the internals before entering. If they confirm the trend, I move forward. If not, I wait. Use them for timing. For day traders, internals can pinpoint when momentum is shifting. A sudden spike in the tick or a reversal in the vol spread often signals the exact moment to pull the trigger to stay out of trouble. If the internals are mixed or choppy, I know it's better to sit on my hands instead of forcing a directional trade. But this can also be a great time to make a neutral trade. Now I'm going to show you a demo of the market internals. Today, there was a big meeting with the Fed at Jackson Hole. Well, let's take a look at what happened with the market. First of all, you can see that if you're looking at the S&P 500 on a 5-minute chart, we had a big explosion right at market open. This right here is where the market opened, and the S&P traded higher initially on high volume, but then boom, off it went. I always have the market internals grid up on one of my monitors so I can see movements like this happening. When you get a strong move in the S&P futures and that's backed by strong market internals, generally that's going to be a good time to get into long trades. If we look at the ticks, for example, to see what was happening this morning, what you'll see is that the ticks were up above the plus 600 line. The plus 600 line is generally the area where we say that there's significantly more buying than selling. And what we're looking for is consistent tick action, not just one spike up and then a lower move. In this example, you can see that the ticks were up above the zero line for the first 15 minutes of the market open. Not only were they up above the zero line, but they were up above the plus 600 line. That demonstrates some pretty consistent buying for a good 15-minute time frame. Now, after that, you'll see that yes, the ticks did return down to the zero line, which is neutral, but for the most part, they were staying up above that zero line, and many, many times we're going up above plus 600. That just demonstrates that we're seeing consistent buying pressure, which is why you're seeing the S&P, the Nasdaq, and the Dow exploding. With the vol spread, what we saw today is a consistent line to the upside. I love seeing a nice bullish trend like this. This is just showing that there's continual buying happening and the volume up is more than the volume down. Then we have the put call ratio. If you look at the put call ratio, what you'll notice here is that the put call ratio dropped. Yesterday, it was getting a little bit more high. It got up almost to 0.85, which shows that people are buying more puts than calls. But then what happened was it dropped and gapped down today. And now today it's down to 0.64. That means traders are coming in and they're buying calls. Now, if you look at the VIX, another important factor that we saw today was that the VIX dropped like a rock. This again is because of Powell. And when you see the VIX dropping like this is generally a pretty good indication that it's time to get long. So, what you'll see here is that by looking at the market internals, you can combine that with the overall trend in the indexes. And then that gives you a good idea if you have a bullish day, a bearish day, or a neutral day. And for example, on a day like today, it's a great day to buy the dip. Now, if all these market internals are flipped to the opposite side, that may be a pullback day or a big sell off day. So remember, the market internals are your x ray vision into the market. They tell you if the foundation is solid before you step in. Want to learn more about the market internals? Check out my market internals class. And now, for a limited time, you can take advantage of our Labor Day sale and get 30 days of live trading with our team of traders in the Mastering the Trade room, John Carter's Squeeze Pro, and his new 2025 Squeeze Pro course, and my internals class for just $247. We don't do bundles like this often, so take advantage of the sale while it lasts. And lastly, don't forget, you don't have to trade blind. Use the tools the pros are watching every day. See you in the next one.